Inheritance tax. No one likes to discuss it, especially as you get older. Trust me, I know. So welcome to Market Wrap number 200. This week's topic arises from a discussion a client was having with their parents last week. She said that they didn't want to discuss the topic death. It was too taboo. So it's something that's got to be done, I'm afraid to say. But here are 6 easy and completely legal ways to avoid inheritance tax or plan for it. Okay? Now, inheritance tax, to give you some background, is Britain's most hated tax charge. I don't know, stamp duty runs it pretty close, I think. But until recently, it was only very wealthy who had to pay it. Data released by Her Majesty's Revenues and Customs, HMRC, shows inheritance tax income for the government reached an all-time high of 7.1 billion in 2022-23, a 1 billion increase on a previous high of 6.1 the year before. For the states that do get caught out, the tax burden can be huge. So how much can you inherit before you actually have to pay tax? A measly £325,000, which hasn't changed since 2011. Over and above that, you pay 40% tax on everything unless you plan. So, number 1, best way, give your assets to your spouse. If you want to cut your inheritance tax bill, then it helps to be married or in a civil partnership. You can pass on assets of an unlimited value to a spouse or civil partner without any inheritance tax liability. According to HMRC, on the first death, couples shielded 15.7 billion from inheritance tax in 2021, the latest of which figures are available. Since the rules changed in 2007, spouses have also been able to inherit their partner's unused nil rate band when they die. This means that surviving spouse could see their allowance grow to £650,000, and then if the couple owned a home together, the allowance can go as high as £1 million. However, the unused allowance is not passed on automatically. You must make a formal claim to HMRC within 2 years of the death of the spouse. Otherwise, your family could face an unnecessary tax bill. Number 2, leave your home to your children. For many families, a property is the most valuable asset they have. In fact, rising property prices are a major reason why annual inheritance tax revenue has doubled in the last 10 years. Fortunately, homeowners get an additional £175,000 allowance called the residence nil rate band if they pass their main property to family members. And because spouses and civil partners can combine their allowances, they can pass on a total of £1 million in wealth without incurring a tax bill. Bear in mind, we are not tax advisors at APW. Best to speak to a professional about this. We're just giving you our opinions. But it pays to be aware of some age restrictions. Ian Dial, a wealth manager at Evening Partners, said the property must be a residence of the deceased and it must have left to the children or grandchildren, not the nephews, nieces, brothers and sisters. If the person downsized to a less valuable home before the death, they can still do the residence rate band. This is called downsizing relief, and it can apply if you sold your more valuable home after July 7th, 2015. Calculating how much downsizing relief you can claim is complicated. However, as this depends on factors such as the value of the residence, nil rate band, and also the home when it was sold. Ms. Grivin said, although the residence nil rate band was introduced to ease pressure on the transfer of the main residence, the rapid growth of house prices means that many who are entitled to it will nonetheless pay hefty bills. For estates worth more than £2 million, the residence nil rate band allowance is reduced at a rate of £1 per 2 over the threshold. If the residence nil rate band is not enough to protect your wealth, then you should make most of your gift allowances, which is basically giving away money. I hate the thought of that. Perhaps the simplest way to do that is to just give your assets away during your lifetime. It's often overlooked but highly tax efficient method basically is to give out cash from surplus income. This must be money you can regularly be without, and it must not significantly change your lifestyle. It cannot be money that comes from a house sale, for example. Chris Etherington of the tax firm RSM said, the gifts don't need to be of equal size, they just need to form a pattern, i.e. regular. You should also keep detailed records of the gifts made in case HMRC asks for evidence of the gifts after death. On top of the gifts out of surplus income, every individual gets a £3,000 annual exemption. Not many realise this can be carried forward for following tax years. So you can give away £6,000 if your allowance is unused the previous year. There are additional allowances for weddings or civil partnerships, although how much you can give varies depending on your relationship to the bride or the groom. Another exemption is a small gift allowance, allowing you to give away up to £250 per year per person, but not to anyone who has already benefited from your £3,000 annual exemption. All these gifts are immediately free from inheritance tax, that is to say, they are excluded from your estate. For gifts outside these categories, the 7-year rule applies. So what is the 7-year inheritance tax rule? Large gifts in excess of £3,000 can be made without incurring inheritance tax, but only if you survive the gift by 7 years. Okay, that's called a potentially exempt transfer. I like that, pet. So during that window, that's what they're called, pets. So you can make sure you have lots of pets and you live for more than 7 years, then they're tax-free. Any pets that exceed the tax-free allowances from inheritance tax will be tax-free. So it's a very good way of doing it. Gifts made within 3 years of death are taxed at the full rate of 40%. After that, taper relief will apply on a sliding basis. More and more taxpayers are falling foul of the 7-year rule. Families were charged 197 million on potentially exempt transfers, pets, in 2017-2018, up from 156 million for the year before and 135 million for the year before that, according to HMRC figures. This is why it makes sense to give as much money away at a younger age as possible. How Mr. Dial says, it is obviously important to consider how much you can afford to give on this without leaving you or your spouse vulnerable. Next way to deal with inheritance tax, pass on your pension. Regardless of whether you've touched your pension savings, you can pass on the entire pot to your beneficiaries inheritance tax free. So even if you use your nil rate band and residence nil rate band relief, you can still give away £200,000 in pension wealth, therefore saving another £80,000 in inheritance tax. Just be aware that a beneficiary would have to pay income tax as they draw down from the pension, but only if the original pension holder dies after 75. Mr. Dar said another advantage of incorporating pensions into your estate planning is you can still access these funds if you ever do need to draw on them to pay for care for yourself. Next way of dodging it, take out a life insurance policy. If there is nothing you can do to avoid inheritance tax, you can still insure yourself against the final bill. Taking out a life insurance policy means that when the tax is due, the charge can be paid out of your policy rather than by your beneficiaries. However, it's important to shield it from the estate, otherwise the payout will increase the estate's value and potentially the amount of inheritance tax as well. Obviously, if you take this out when you're 80, it's going to be quite expensive, and the older you get, the more expensive it's going to be. A simple way of planning as well is do a will. Okay, at the moment, 31 million UK adults don't have a will, over 1 in 2. Of the 60% who have no will, over a fifth believe they don't have enough assets to make it worthwhile. And bizarrely enough, if families in Liverpool are most likely to suffer the consequences of a relative having no will. So it's a higher proportion of people there. If you die without a will, it's what they call dying intestate, and it can take up to 2 years for the estate to be released, as it goes through a formal legal process which involves lawyers and government departments. So get a will, get a letter of wishes at least, have a power of attorney set up if you're older to put other people in charge of your estate in case you're not able to do it. I know it's not a particularly savoury topic, but we all have to cover that at some stage. So that's it for this week. Market wrap number 200. Never thought we'd get to 200. I wonder if we'll make it to 400. Please do like, subscribe if you can. It helps with our ratings on YouTube. And thank you very much for watching. Cheerio.